As India battles the second wave of the COVID-19 pandemic, the net effect of depleted savings, increased debt, and lower financial security is an increasing worry for individuals who were not prepared for financial needs. Extrapolating that to states that are battling the pandemic, finances have been strained, potentially causing a worry for governments as well. Well, India's fiscal response to the COVID 19 pandemic has so far been conservative, according to a new report, which suggested a 5.5 lakh crore rupees stimulus package to deal with the crisis. India's central bank, the RBI, in a bid to provide liquidity support in the fight against this pandemic, recently announced an on tap liquidity window of 50,000 crore rupees to ramp up healthcare infrastructure and services. But the pressure of a lockdown is mounting, and its impact on the economy will be watched closely for how the recovery shapes up. Why? Because while the Central Bank of India has already pledged to keep the monetary policy loose, its room to act has been constrained by inflation concerns. Now, the RBI has tried to moderate benchmark bond yields under a structured securities buying program after they spiked up. But if supply side inflation keeps up, as state-wise restrictions to stem the virus disrupt domestic supply chains, that could push interest rates up and thus yield. So, what does all of this mean for you, the investor? That's what we're here to find out in this series titled Winning Over Volatility. I'm your host, Gautam Srinivasan, and today I will be speaking with Mahendra Jajoo, who's the Chief Investment Officer of Fixed Income at Mirae Asset, on how some of these trends will shape India's debt markets and what they mean for an investor looking to park their funds in fixed income assets. Mahendra, thank you so much for joining us. Let's structure the conversation in a way that the viewers will understand. We'll first start with the broader economy, and then we'll go into the debt fund space. So looking at the overall economic picture, given the recent spike in COVID-19 cases, what is your view on the overall economic recovery of the country? Because the IMF now says it will revisit its growth forecast in July amid the surge in cases for India. What's your view on this?
So obviously the current surge in the COVID cases, which has taken everybody by surprise, will have some impact at the margin. But this year's lockdown is very different from the last year's lockdown. So the key difference being the lockdown this year is largely targeted at the restriction of the individual mobility rather than a complete freeze on the industrial activity, because there is a lot of learning that has happened from the last year's lockdown. Last year, there was no prior experience of dealing with that kind of a situation. And therefore, this time, the lockdowns are very tight, targeted. There is more of a containment in the micro zones rather than a wholesale lockdown. And we have seen a gradual stepping up of the lockdown as the cases have increased. In the last 15 days, we have seen a very significant deterioration in the situation. But now, for the last couple of days, the numbers are stabilizing, although still they are on a very, very high side. So, given the fact that the lockdowns are very well targeted this year, the impact on the economic recovery at this point does not look to be very significant. Of course, as I said, at the margin, the impact will be there. The second reason the impact will be not very significant in terms of the projections is because even before the second COVID wave, the projections of the economic growth were largely focused on the industrial activity, because the service side, which is the travel, vacations, cinema halls, shopping malls, etc., they were yet not fully functional. People were not still very emboldened to go out openly, so the activity was restricted. And therefore, I think that we cannot ignore the impact that will be there on the economic growth prospect, but the impact will be margin. So like last year, we saw a contraction of 25% in the first quarter when the lockdown was at its most severe. But this time, I expect there could be a percent or two cut in the growth forecast from, let's say, about the broad range of 11 to 12% to somewhere closer to 10%, which is still good. Obviously, if the lockdowns have to extend and if the situation does not come in control by middle of May, as the experts are projecting, then we'll have to take a further cut in the growth projections.
All right. So you don't expect a significant dent, but Looking at the global impact, I mean, vaccination drives across the developed world have progressed at a good rate, but the potential spread of the Indian mutation could pose a material risk to the economic recovery in India and around the world. So, how do you think this will impact the debt market?
So, if you look at the data across the world, if you look at the data in US, if you look at the data in Europe, which has had a very severe second wave, the second wave has had much lesser impact on the economic recovery as compared to the first wave. And therefore, as I said, that there will be impact at the margin, but it will not be very, very significant like last year. As far as the debt market is concerned, fortunately, unfortunately, revival in the COVID situation at this point is working in favor of the fixed income markets, as we saw from the RBI's out of turn press conference couple of days back. RBI is determined to ensure that there is stability in the financial markets and that the recovery prospects are not hampered because of this. And like last year, they have already started taking a few special measures, like the special line of credit for the healthcare sector, or the counting of the MFI lending by the SFBs as the priority sector lending, etc. So I think in the first leg of the COVID situation, it is positive for the fixed income markets. We have seen the 10-year yield come below 6% after a gap of nearly a month and a half, because it makes the Reserve Bank that much more resolute. And in a backdrop where the macro fundamentals are largely stable and the global environment is also stable. So the one adverse impact on the macro fundamentals because of the COVID will be perhaps a larger than projected fiscal deficit. But then if the Reserve Bank is already in a very aggressive mode as far as the supply management is concerned, then at this point, I think the expectation will be for the interest rates to remain range bound rather than for a very sharp spike in the interest rates at this point in time.
All right. But what about the balancing act, right? I mean, that's always been the case. It's growth versus inflation. That's the balancing act any central bank follows. And in a recent announcement, the Fed had reiterated that they will hold off tapering till the economy hits a 2% inflation and higher employment rates. In India, too, RBI's Monetary Policy Committee has maintained that it will continue with the accommodative stance as long as it's necessary to sustain growth on a durable basis. And I want to focus on the word durable. How long do you think RBI can afford not to react to gains in inflation and maintain that same stance?
So there are two parts to it. First of all, as of now, we have not seen any significant, projection of a sharp surge in the inflation. The expectations are that the inflation is likely to spike. In fact, in the advanced countries like US and UK, now the markets are forcing the central banks to recognize inflation, but the inflation concern in the mind of the central bank seems to be the last priority at the moment. Now, at what point does it change? We'll have to see, and we have to wait and see. But at this point, the central bank seems to be giving a clear message that inflation, even if it goes up on a transitory basis, will not be something that will derail their current economic and monetary policy. Last year, we saw that in our country, inflation went to 7.5% and plus. But the Reserve Bank continued to follow the interest rate policy, which was on the softer side. So I think we have to wait for the developments. But yes, we cannot ignore that concern. But if you look at the current, overall big picture, I think the central banks are in a very charitable mood. They are willing to overlook and ignore inflationary conditions because they believe it is, or at the best, going to be transitory in nature. But the market data does not seem to suggest that. So let me just give you an example. In US and in the European countries, what we are witnessing is that the input cost inflation is far higher than the output cost inflation, which means the manufacturers are not passing on the higher cost at this point to the consumers. But then if the demand improves with the vaccination and everything, that at some point the input cost will be passed on to the buyers or the consumers. And therefore, there is a clear case for the inflation to go up, but at the same time, there is a still clearer, cry from the central banks to ignore it. We have to see where it settles, but at this point, it doesn't look like it will be a big concern. But when it does become, we'll have to be watchful of that. As far as the RBI is concerned, my view is that the moment the Fed acknowledges inflation, Reserve Bank will also be forced to change its policy, because we are, as a country, hugely dependent on the foreign capital flows. We are already witnessing the first signs of negative capital flows for the last couple of months. And if, because of the concern on the economic growth, if the equity markets begin to correct and the FPIs start withdrawing, that I think is the key factor to watch. If the FPI flow turns negative, then I think Reserve Bank will have little choice but to review its monetary policy stance.
All right. And we've seen the recent yield spikes. Do you think RBI via measures will try to make yields at the longer end of the curve remain anchored? Do you think the worst is behind us? I want to get this question answered from you before we go into investment options, because we've seen the 10-year bond yield spike up. It's come down slightly right now. Folks suspect it's the RBI intervention there. So in your opinion, do you think RBI would want to make yields at the longer end of the curve remain anchored?
Look, RBI has been very explicit. They have not made any secret of the fact that they wanted to keep the interest rates low, because that is what supports the economic recovery. If the interest rates spike at a time when the growth is anyway slower, then it doesn't help. There is no secret about the Reserve Bank's intentions. The question is for how long they can continue to maintain that. As I told you, that the moment the global environment turns adverse, and the FPI flows turn negative, that will be the point to watch. At this point, likelihood of either is very, very low. But so the key factor remains for how long the inflation doesn't show up in the developed markets. But we are at least 3 months away from that situation. So we need to continue reviewing that. Reserve Bank is very resolute in its stance. And I think that it is not very wise to fight the central banks, because they have unlimited tools at their disposal to achieve their targets. So therefore, I think at this point, one has to be somewhat of on the camp that says that the interest rate should remain range bound, but be watchful of how the future developments take place.
All right, let's see what this all means for the average investor. Now, investing into a debt fund can seem complex for the new investor. So, give us an overview on the kinds of debt tools an investor should ideally include in their portfolio, and how an investor can take advantage of the current yield curve that is in play.
So, I can largely talk about the debt mutual funds, which, in my view, anyway, offer a very good option to the investors, because the rest of the options that you have in the market in terms of fixed deposits, which don't give a very attractive yield, then if you look at the other instruments, they might have their own issues in terms of the fluctuating liquidity in the market, and they are also subject to the same volatility in the market price. So if you look at the debt space, essentially you have three buckets where the investor can choose. One is the very short end of the maturity curve, which is the liquid funds, and the ultra short-term funds, which are largely targeted for investors who have very short-term surplus and where their risk appetite is next to nothing. Then you have the short-term fund and the low duration funds, which invest in the maturity bucket of somewhere between 1 to 3 years. And in the current environment, which is so uncertain, that seems to be a reasonable bucket to look at, because let's say if you're looking at a low duration fund, if the interest rates go up and even if there is some blow to the NAV, but because most of the papers will mature within next 1 year, that loss in the NAV will flow back into the returns to as and when those papers mature. So that is a very good option for the investors at this point in time. And then for investors who look at debt as an asset allocation, who are long-term investors in nature, for them the banking PSU fund and the corporate bond funds are reasonable options, because the interest rate cycles move in line with the fundamentals, but interest rate is a generic macro fundamental. When over the last 6 months there has been so much debate that interest rates will go up, but at this point in time the interest rates are barely a few basis points higher than their historic low. And therefore, I think to be very skeptical and negative hasn't helped investors. In my view, for long-term investors, appropriate to continue to remain invested. Interest rate cycles will come and go. What we have seen is that at whenever one cycle is completed, investors do earn very reasonable returns. So I think the investors need to largely understand these three buckets and then see which bucket suits them most. And in consultation with their advisors, they should choose the appropriate option.
All right. And what would you advise to investors in terms of expectation management when it comes to returns? Because that's also something that folks would wonder, because we see many new products also being launched in the market. Some fund houses have launched target maturity funds given the uncertainty in the interest rate trajectory. Some are recommending dynamic bond funds. So in your opinion, what's the best way forward when it comes to fixed income asset allocation? And in terms of returns, what would you advise to viewers in terms of managing their expectations?
So, we as portfolio managers generally don't get very deep into these areas because these are areas for their investment advisors to, look at depending on each investor's specific situation. But at a very general level, I think expectation management is required for, investors who are not very smart or, who don't understand the market. So it is their money. They need to understand and do enough due diligence to understand that this is a hard word and the markets are for real. So volatility will be there. I believe that the investors should not worry too much about the volatility. They should follow their own investment horizon and risk appetite. That is the key to their success in terms of achieving their objective, rather than looking at the market, because markets are always going to be unpredictable. The valuations will always look expensive. The concerns for a country like India with high debt to GDP ratio and the current situation of COVID and expectation of larger fiscal deficit, they will continue to bother. But then you have to balance it with the fact that in the extraordinary situation that we are in, most global central banks, including RBI, are extraordinarily supportive. So they balance out each other, and then it is left to what is the balance sheet strength and the resolution level of each respective central bank. The Reserve Bank has done a commendable job in the last 1 year, and it has belied all negative projections. So I think the investors tend to over worry about the market volatility and what happens if the interest rates go up. If interest rates go up, nothing happens, just that you need to give enough time for your investments to come back to the market levels where the returns for them become attractive. So I will only give three advice to the investors. Focus on your risk appetite and investment horizon. My second advice is also the same, and third advice is also the same. Choose the right product. That is critical because, those are the two things which the investors understand best, and those are the two things on which they have the maximum control.
All right. But looking at interest rates, the last few months have seen interest rates rise from its lows and fall again post the cancellation of the auction by the RBI. So what in your view is going to go on with interest rates moving forward? How do you think the trajectory is going to go?
So at this point, as you have said in so many different ways, that the interest rates don't really have the fundamental tailwind to head any lower. We are already at or near the record low interest rates in the context of the big picture. And we have huge headwinds in terms of the very high fiscal deficit, poor demand in the environment, and the inflation, which is, a concern for everyone. We are already, in terms of core inflation, closer to the higher end of the target of the Reserve Bank of 4 and 6%. So therefore, a normal case would be for the interest rates to go up. But at this point in time, we are seeing the central banks which are extraordinarily active and supportive. Therefore, the interest rates have not gone up. So let's say in the absence of the devolvements which the RBI gave in the auction, or the auctions that the Reserve Bank cancelled, or the aggressive open market intervention that the Reserve Bank has done, possibly the interest rates would have been at a much higher level than they are today. So the key to projecting the interest rate outlook at this point is at what point the central banks may change their policy stance. And as I explained, the two pressure points will be if the global central banks acknowledge the presence of inflation, then the scenario changes. And two, if the foreign investors start withdrawing money from the country. These are the 2 points to watch. If that doesn't happen, then the interest rates will remain low. Now, again, the current discussion is happening again because of the sudden spike in the COVID cases, and the current mutants seem to be highly infectious. The positivity ratio for the tests that are being conducted is on very high side. In some states, it is closer to 25%. That's not a good sign. So again, we have to see how bad the situation can get. A large part of the rural hinterland in our country does not have elaborate health infrastructure, and therefore in some cases we don't get the true numbers because the testing isn't adequate. On the other side, if there are cases, there is collapse and higher than the warranted sufferings because the healthcare infrastructure is not up to the date. So if we do not begin to see the curves stabilize and flatten by second week of or third week of May, in the next 7 to 15 days, then I think the sentiments will begin to turn adverse, and then the things can become tricky. But at this point, I think largely we have to believe that the interest rates will remain range bound, and we have to see if at all the two factors which I mentioned turn against us.
All right, but if I have to take the worst case scenario, because there is talk of a third wave coming as well, right? And a scenario where, let's say, interest rates start to see an upward movement and keep moving up, what kind of debt funds can investors park their money into?
Well, if the interest rates, if one believes that interest rates will go up, then the investors, I think, have two choices. They can put money in the liquid fund, or if they have a slightly longer investment horizon, then they can put money into the low duration funds. But obviously, with an expectation of a sharp increase in the interest rates, investor wouldn't ideally opt for any other longer duration fund. So the key question is therefore whether that expectation, that kind of a negative expectation, is a realistic one. That's why I said the investors should look at their risk appetite and investment horizon rather than worry too much about the interest rate volatility. Because if the investor is investing for next 3 years, even if the interest rates go up in the next 6 months or 1 year, ultimately over a 3-year period, typical interest rate cycle of late has been 2 to 3 years. So if the interest rates go up and if the investor has the willingness or the risk appetite to remain invested over longer period, the fund manager will be able to reinvest the new maturities in the fund at higher yield, and the new money will also be invested at the higher yield. So experience is that when you are investing in a difficult environment and when the environment improves, it results in good returns. So therefore, I think the whole worry about the interest rates going up is a little bit overblown in my view.
And before I come to my last question, looking at the expanding product universe within the debt fund market, and it looks challenging due to continuously evolving dynamics. What, according to you, are the pitfalls to avoid? What are the key factors to bear in mind while investing into debt markets in today's times? You've given some suggestions early on, but what are the pitfalls to avoid for investors?
So I think the first and the most important, in my view, credit is the devil, because if, let's say, economy begins to deteriorate, the first set of companies that will be hit will be the weaker companies with lower credit ratings or poor operational cash flows. Last year also we saw that in the absence of the moratorium and the credit guarantee which the government had given, the things could have turned very, very nasty. And in 3 years before that also, we saw a sequence of credit defaults which did result in a reasonable amount of pain to the investors. Now, there is one common thread that one can observe in the second wave and third wave situation in most of the countries, that the government support has not been of the same order. The first time the government came out far more strongly than in the second wave and the third wave, because things began to evolve in an expected way, because last year it was completely unexpected and little bit forced. This time the lockdowns are also not as strong or strict as they were last year. So therefore, if the things get worse from here, then the credit will be affected the worst. And the first, I think the care that should be taken is to avoid aggressive credit. It doesn't mean that you just don't take any credit risk. You look at corporate bond funds which have 80% investment in AA plus or better rated instruments. So if you avoid credit, then I think half the job is done. The second is to not have a mismatch either in terms of the expectation or risk appetite, because let's say if someone is invested in a longer duration fund like a dynamic bond fund, those funds can have negative returns for 6 months at a time. They can see a lot of volatility. So if the investor doesn't have the stomach to be able to absorb that volatility, then there is a possibility that he will get out at the worst possible time. So therefore, it is important. I think as long as these two factors are taken care of, debt funds are, a beautiful product. They give you immediate liquidity, they give you transparency, and now SEBI has come up with so many new measures like riskometer, and the new regulations have come where the funds have to maintain 10% liquidity in the funds, etc. So the whole ecosystem has become stronger and more robust, and therefore there are far many tools and information available to the investors to assess or do a due diligence on different types of funds.
I'll take a cue from the second factor which you mentioned, which is about risk and risk management, to sum up the discussion. How does an investor invest in debt markets without a risk on capital? Because that's always the expectation when they go into the debt route, right? That I want as low a risk as possible. So how do they do that?
First of all, there is no free lunch. Debt funds also have their risk factors. So people have to be very clear in the mind that they can't have a return which is higher than the bank fixed deposit without taking additional risk. That is daydreaming. What is important is for them to understand the risk and then understand whether they have the stomach to absorb that risk. Now, debt funds have primarily two types of risk. One is the risk of the volatility in the NAV on account of the interest rates going up and down. And the second risk is of credit risk. Now, we have seen that if one happens to encounter one credit event, that can set back the investor by a huge margin. So it is important to avoid aggressive credit, and then do not assume that there is no risk, but be prepared that I am going to earn higher returns by taking this risk. The risk of volatility kills people. There is an overwhelming feeling that I should not ever see my NAV go below my capital or my cost. That is not how the markets work. Markets are always going to be volatile and predictable. So investors should, I will repeat, first get out of the expectation that there will be no volatility. There is going to be risk. The equation they have to see is the risk reward. If you get a higher return by being patient with risk and volatility, then is the only time that the investor can earn higher risk. Don't assume that there is no risk, but ensure that your objectives factor in those risks and then you invest. And I am sure that every investor will end up with a very happy experience.
Well, we sure hope so. But as they say, promises make debt and debt makes promises. So let's see where we land from here on. Thank you very much for speaking with us, Mahendra, on the topic of how to invest in debt in a rising interest rate scenario. This has been a special presentation as part of the Winning Over Volatility series for our viewers. This is Gautam Srinivasan signing off. Have a great day.
Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.